Hello, Jim here. Today I've got two stocks for you that are not overpriced and they could potentially double in the next couple of years. And you can actually earn some really good premium on them. So I'll share with you why I like them so much, the fundamentals using Seeking Alpha. And then I'll also go over some recent trades I made with them and then give you kind of a setup that you can use for both of them. So stay tuned. I think it's going to be well worth your while. Okay, now the first company I wanted to talk about is U or Clear Secure. If we take a look, they're a security company. They work with the airports, they work with stadiums, they work with kind of getting you into places and being sure that secure-wise that you're who you say you are. They're expanding to more stadiums. They're also expanding overseas. So a good, well-run company. If we look at where they are now, they're not really overpriced. They have a PE of, this is a forward PE of 26.5. Let's look at profitability. They have good profitability, A plus. Return on equity is 128%. You don't see that very often. Return on total capital, 31%. Assets, return on assets, 14. They also have good cash from operations. Let's look at growth. They also have very good growth, both in earnings as well as just generally in revenue. Valuation, they're not really overpriced. Let's look at capital structure. Their market cap currently, they're pretty small, 4.2 billion. Total debt, 115 million and over 600 million in cash. So they're very, they don't rely too much on debt. I like to see companies with little debt or no debt. They do pay a dividend, which is a bit crazy, and it's 2.4%, and their payout ratio is only 24%. So my guess is they just started paying this not too long ago, and I could see them increasing it pretty consistently. So you don't see many companies like this paying dividends. Earnings, they recently had earnings on 8.5. They beat both normalized as well as GAAP, and they beat revenue. They had a revenue surprise. They next have earnings in November 5th. If we look at earnings estimates, you can see here they're growing nicely. For this year, they're expecting $1.20 in earnings. Next year, $1.50. And in 2027, $1.86. So if they keep on that trend, they're going to double their earnings probably within the next, probably around 28 or 29. So I could see them potentially doubling, especially if they get momentum. They probably, well, they have okay momentum, but if they really got quite a bit of momentum, they could shoot through the roof. Let's look at financials. I like to come over here and look at, are they buying back shares since they're pretty small? So they've got 95. Yeah, so they dropped about 900,000 in shares. So it looks like they were going up. So this past year, so they actually have a buyback program. I'm assuming they do, which is a really good thing. So, and they're currently at $32. They're down a little bit after hours. Now, if we look at the trade I made on them recently, I closed them and they were expiring on 8/15. So I paid $21 to close them early. While I had the trade running, I believe I rolled it once, but I brought in over 500 in premium. So my total return was 178%. So overall, just a really good company where you can earn fairly good premium. And the fact that they're not overpriced, the biggest mistake you might make with them is not picking up some shares. So I might even buy 100 shares just to own them. I do. I'm not a frequent flyer, but I do have friends that use the service and are quite happy with it. So that's the first company I wanted to talk about. And then again, at the end of the video, I'll show you that you can still make some pretty good income in the setup, but that'll be at the very end of the video. So next, let's jump into the next company, another one that very few people are talking about. So stay tuned. Okay, now the second company I wanted to talk about is Oddity Tech. They had earnings and they barely missed earnings and did drop quite a bit recently. So I decided to make a trade on them earlier this past week. So, and I also don't believe they're very overpriced currently with about a 28 delta. If we come down and we take a look at the type of company they are, so they operate as a consumer tech company that builds digital first brands for the beauty and wellness industries. It serves consumers through an AI driven online platform which uses data science, machine learning, and computer vision capabilities to identify consumer needs and then develop solutions for those needs. Now, their earnings, let's look at their earnings since they just had them on 8/4, and they missed by 1 cent for GAAP. They did beat for normalized earnings, and they also beat for revenue surprise. If we look earnings estimates, this is where it gets a little crazy. So they're expected to do right around $2. I think that's 209 for this year for 25, then 236, then 385, literally a 63% increase in revenues. Then by December, 884. So literally between over the next 4 years, they're going to go from $2 in earnings to 884. I mean, pretty significant, and it just continues from there. Now, I always kind of, when a company is forecasting way out, it's a lot more difficult to forecast past 2 or 3 years. When you get to 4 or 5 years, that can be way wrong. But in a lot of cases, maybe they're 10% off, but some of these are huge growth levels. Now, if we look at growth, they have an A in growth, good revenue growth, good earnings growth, profitability, good profitability. They have return on equity over 30%, return on capital over 20%, and a return on assets over 10%. I'd like to see more cash from operations, but they do have a lot of cash per employee, meaning they don't have a ton of employees. Now we can look at valuation. It's giving them a D because, compared to the sector average, they are a little bit pricey, but being an AI company, they, I believe, have fairly high momentum. Yeah, A for momentum. And then if we go back to valuations, let's look at the capital structure. Market cap, $3 billion. In debt, $22 million. Cash, almost $700 million, $678 million in cash. So the balance sheet looks really good. Let's look at financials. Let's go to balance sheet. Let's see if they're issuing a ton of shares. So 56.8, 55.8. So they're still issuing some shares, not crazy. Actually, it went down 56.9 down to 55. So they're probably just using it a little bit for, paying employees or maybe providing stock options to employees. So everything you want to see there. I'd show you their website, but it's a little squirrely. It's kind of hard to get a gauge. Part of the reason that they did take a big hit related to earnings, and that's why we have that drop, was less about earnings. It was more about a delay of one of their products. Instead of releasing it third quarter, I think they're releasing it fourth quarter. Now, if we look at the trade I did, and again, this is my Patreon, this is what I share with my members. I make the trade, then I literally post it out on Patreon, then Discord. I encourage people to read through it, ask comments, maybe do it differently. Maybe they don't want to do a vertical put credit spread. They can do it as a cash secured put. But I give details. I talk about the trade of 55.45. And over here, we can see currently it's at 58.22. I believe it was, did it recover a little bit? Just slightly. Expiring on 9/19. So this is the trade I really like. I like to go out, close to 45 days. I think when I made this trade, it was right at 45 days. I brought in some really good premium, $387. An annualized return of 195%, which is quite high for these kind of trades. So yeah, it's been on my watch list for a while. They had good earnings, but announced a delay with one of their products until fourth quarter. Not sure if this is the only reason. They are down, but I believe it is way oversold. They are down nearly 20%. excuse me, I've got a little bit of a sinus issue going on. Bit more risk with the trade due to them being down so much. So be sure to do your own due diligence. Um, they have good profitability, little debt. They are growing quickly and have some impressive financial situation. They are growing their earnings nicely. By 2030, they are estimating that they will have $8 in earnings. Again, a quadrupling of earnings. So there's a potential that this stock could double or triple. I haven't compared them, but I wonder how they compare to Palantir. They're much smaller than Palantir, but still pretty impressive with how little debt they have, and their profitability looks so good, and their balance sheet looks so good. So it looks like I paid 105 for the long puts. The main reason why I still purchase those is I don't know what the rest of August is going to look like, or September. Notoriously, these are the two worst months. So I wanted a little bit of protection, and then if it does drop majorly, that long put will become worth a lot more, and I can sell it and lower my cost basis. Or if I change my mind and I don't want to own these, then I can also put it to someone else. So that's what I wanted to show you with both of these companies. Next, I'll share with you what a current setup looks like and how I like to pick my expirations, identify the deltas. So stay tuned. Let's jump into the next section. Okay, now I've opened up my Schwab Trader page. I like to use this page primarily on YouTube just so it's easier to show people. I really like what Schwab's done with this page recently, but this trade originally was what I call a wheel trade. It was in one of my wheel trade strategies. I believe it was the 25,000 strategy. And in this case, I was doing a very thin spread. So originally, if you look at my trade that when I first did it, it was 4 vertical put credit spreads with 25. So I sold the 25, bought a 22. And originally it had an expiration of 7/18. I made this trade on June 10th, so a little bit over a month. The delta was 33. With my wheel strategy trades, I will take a little bit more risk, but the annual return was 220%, which is typically higher than a lot of my trades. Now, if you needed to make a new one, I'm showing a 31, which this is why I really like this page that Schwab has done. This is also right around a 34 delta, so a little bit more risk. So I could sell a 31, buy a 28, and still make between 62 and 85 cents. And the reason I do 4 is because it's such a thin spread, as well as it's an inexpensive stock. You know, if this was a Google or an Apple, you know, it'd be over 200 per contract. So this is for 4 contracts. And what I typically would do is I would play around with it. I might say, well, what if I go to a thinner spread and it's still not very, not bad. It's a little bit less, but I probably would go closer to 70. So I might even consider a 31.30. Let's look at a 31.30. And that's where it changes. It does show negative, but again, the numbers aren't bad. So I might pick a 55 and then go a little bit higher, closer to the 110. And that's what I tell people is look at that long put. You might find that a thinner spread may be the better trade to make. And that's what I'm looking at here. And then I would go pretty close to the 110. So I might go to 105, or I could type it in. So I could type this in as, there we go. So it'd be 440, and then maybe I'd go a little bit less. Now, it could be the numbers are a little bit squirrely with being on the weekend. But if you could get this kind of a amount of premium, it would be really, really good. So again, I'm selling to open a 31 put, which I'd be happy to own clear at 31, but then at the same time, I'm buying to open a 30 just to have that downward protection. Because again, if the market drops significantly and say clear goes to 22, then this long put will be worth a lot more. It might be worth $6 or $7, which would allow me to lower my cost basis and own these shares anyway. Because again, I think they're going to do really well in the coming years, probably double in the next 3 or 4 years. So I would definitely want to own them. So that's what Clear looks like. Now, if I came over and I looked at Oddity Tech, and again, this is the AI company that's potentially going to double or triple, well, actually quadruple their earnings over the next 4 or 5 years. So I could see them also doubling or tripling over the coming years. So, and they're currently at $58. So they were down. Now they're back up. But here you can see I did a 55.45. This is the trade I like. Another vertical put credit spread. I'll go out. This time I'm going out, what is it, 40 days. So again, 40, I'll go 60 to 40 days. I'll even do monthlies. It depends on the amount of premium. I like to get at least $100 for every contract. So, but you can see at 55, what is the delta here? So the delta is 0.35. Now this is not a wheel trade, so I probably would take less risk. So I'll lower this to 50. And then I would buy to open. So it dropped to 45 to 50. So I'm not getting quite enough. So I probably would go a little bit lower here. And that's getting me, the high, the ask is a little bit over $1. So closer to what I want. And I typically will do 2 trades. And then again, I would pick the 105. So for some of these companies, especially if they're having a really busy day, meaning a lot of open interest, I will go all the way out to the 105 and pick that that value to use. If it doesn't get filled, then I'll lower it by another $5 and then see if it'll get filled $5 cheaper. A lot of times, both with Fidelity and Schwab, I'll keep doing that till it does get filled. And then usually, I've been surprised. Some will get filled right away. Others, I might have to go down once or twice. Probably my average is twice. I've had to go down 3 or 4 in certain instances with certain stocks. Now, with the fact that these are $5 spreads, you know, a 45, I would try the 45 just to see. And again, I'm losing a lot of premium, so I would stick to the 40. So when the spread is so much, the $5 difference between the strikes, it's a lot of times harder to get really good premium for a thinner spread. But I still check it. You never know. So again, this is what this is telling me is I'm selling to open 2 contracts. So it's obliging me to owning 200 shares if the shares get put to me at $50. But I would pick up about $100 or $1 per share. So my cost basis would be more like 49. Now, again, I'm buying the lower protection. If you wanted to do this just as a cash secured put, you could delete it and then you would pick up a little bit more potentially. And then, you know, you could do it as a cash secured put. Now, I like to have the long put protection. Again, if the market takes a dive in later August or later this month or early next, and the stock drops to 48, you know, literally $10, that long put, instead of it being worth, you know, anywhere from 25 cents to 50 cents, it would probably triple. It would probably be worth, you know, close to $1 or maybe $1.50 or something along those lines. And that's what I find. I had a number of positions assigned to me back in April of companies I really wanted to own. And that's how it worked out. I ended up selling a lot of those long puts and made really good income and really reduced my cost basis on the particular shares. So in this instance, I would click review order and then I make sure everything looks correctly. A lot of people, beginners will, and even people who have been doing this a long time might get these backwards. They may, you know, have this as buy to open and this is sell to open, especially if you're in like a Fidelity and you click on one of the buttons from the option chain, more so than Schwab, it'll sometimes build this similar page in Fidelity and you might not realize because it's not as clear as day on that trader page, and you might put the trade in backwards. If you do that, just reverse the trade. Go back in. If you did this, you paid 144. Just go back in and do the same trade, but reverse it. Oops, buy to open. And you can see it's about the same amount. So you can reverse it and then do the trade one more time to actually make the trade. But definitely don't panic. I've had members who have done a little bit of everything. I've had one person who held the key down, and instead of doing one contract, they did 100 contracts. It worked out okay from them or for them. If something like that happens and the trade has been accepted, just call the trader desk for, whoever your brokerage, Schwab, Fidelity, Robinhood, or, whoever it might be, and get them to address it for you or with you, just in case, because it might go against you. And when you have that number of contracts, it could be a pretty big loss if you're not careful. So I would review the trade, place it, and then I would keep an eye on it. I typically will manage these trades starting around 21 days. Recently, I've been trying to close them. A lot of these trades I can close 10, 15, 20 days early, which really increases your return. I might have had a 150 return, 150%. If I close it 10, 15 days earlier, then it's like a 200, 250, 300% return. So that's what I wanted to share. I probably will look to buy some of these shares in these companies, especially before they ramp up, but when I do, or if they get assigned to me, I'm going to be really careful with selling covered calls, because these are definitely two companies that could shoot through the roof, and covered calls could limit your upside. I like to call it clipping your wings. So going forward, I'm probably going to use what I've talked about in previous videos, my filtered covered call checklist, which helps me to identify, should I do a covered call? Or if I am going to do a covered call, maybe I need to do a covered call spread, meaning also buy the long call to limit, the upwards potential that I might miss if the stock shoots through the roof. So any of you out there who have Palantir or a lot of the other companies like Palantir who, APP or some of those that shot through the roof, that's one way you would only miss the spread, and then you would continue on its upwards trend because you had purchased that long call. So sorry I got a little bit wordy at the end here. Let me know what you think. What do you think of these companies? Do you have some other companies? Add something in the comments. One thing I do get a lot of comments is, what do I think of this company? If they don't make earnings, I typically will add them to my watch list, especially if they look like they're going to be having earnings fairly soon. But I do get a lot of people that ask those kind of questions. And I do have a lot of companies sitting that aren't quite making money yet, but soon will, kind of like these two that I'll start trading on soon. So thank you for taking the time to watch, and I hope you have a wonderful evening.